Hi, I'm Wendy Black, Head of the Incentives Department at Entertainment Partners. In this video, we're going to discuss the California Film and Television Tax Credit 3.0, which has an effective date of July 1st, 2020. Program 3.0 includes various changes from the previous program, as well as some additions to the program. To help navigate Program 3.0, I'm joined by two people who know the California Film and Television Tax Credit Program best: the Executive Director of the California Film Commission, Colleen Bell, and Program Director, Nancy Ray Stone. We'll start with Colleen. Welcome.
Thank you for joining us here today to hear more about the California Film and TV Tax Credit Program 3.0 and the application process. California is home to the entertainment industry, and for good reason. We have beautiful weather, wildly diverse locations from 840 miles of coastline to vast desert sand dunes, highly skilled crews, and the best production infrastructure in the world. Here at the CFC, our vast array of tools and resources help to navigate production issues, provide logistical assistance, we have an online location library, and we provide permitting for all state-owned properties. And thanks to the efforts of California leadership, the legislature, and stakeholders, we are very pleased to launch the California Film and TV Tax Credit Program 3.0. The $1.55 billion program runs for 5 years with a sunset date of June 2025. Each fiscal year, July 1st through June 30th, the $330 million funding is categorized into TV projects, relocating TV, indie features, and non-indie features.
Thank you, Colleen. Nancy, let's go over some of the basics of the program and how the new version will differ from 2.0.
Sure, let's dive right in. In Program 2.0, just like in 3.0, there's a 20% non-transferable tax credit for non-independent productions and a 25% tax credit for relocating TV series, as well as independent films, which are produced by companies that are not owned more than 25% by a publicly traded company. One of the changes in Program 3.0 is that independent films are now bifurcated between projects with qualified budgets of $10 million and under, the smaller indies, and those with qualified budgets over $10 million, the bigger indies. With this change, independent films will now compete for funds with other independent films in the same budget range. Another change is that relocating TV series must now have filmed at least 75% of principal photography of their last season outside of California in order to qualify. Like in the last program, there's going to be multiple application windows for the various production categories, and the dates will be posted on the CFC website.
Once a production is applied within one of the application windows, how does the selection process work?
I'm glad you asked. Projects are selected based on their jobs ratio, which is a formula that includes qualified wages, 35% qualified non-wages, and other factors that we call bonus points. The bonus point factors include principal photography days outside the LA zone, visual effects qualified spend in California, and music scoring and recording labor in qualified positions, which we delineated in the program guidelines. Bonus points in these areas are offered for all projects except smaller indies, which only can earn bonus points for principal photography days outside the LA zone.
What about the bonus points for shooting in an approved facility?
There will no longer be bonus points for shooting in an approved facility. Those points have been replaced with bonus points for music scoring and recording labor as an incentive to take advantage of the accomplished musicians here in the Golden State.
One thing we noticed is there are now only 7 bonus points for visual effects. In Program 2.0, a project could earn up to 15 bonus points. Why the reduction?
Well, in 2.0, costs paid to a visual effects vendor were classified as all non-labor, which was tagged QE, and all that non-labor cost was lowering job ratios, which was not the intention. So in 3.0, we can now split visual effects vendor costs, 70% wage, 30% non-wage, and so the bonus point structure was modified because less bonus points were needed.
That makes sense. Thank you. As for the timing, when will productions know if they've been selected?
So after submission of the application, projects are ranked by jobs ratio, and the top 200% of projects for which we have tax credits go from phase 1 to phase 2. They then submit their budgets, scripts, schedules, and other documentation, and we notify them within 4 or 5 weeks if their project will get a reservation of credits. We take the top 100% of projects based on their revised job ratio ranking. Those are the projects that get into the program. And it's important to note that a production may not begin principal photography prior to receiving a credit allocation letter, and no costs qualify until the letter is issued.
So Nancy, during the time while productions are waiting to find out if they've been selected, what if they began building sets prior to the CAL date? Can those costs qualify or be prorated?
Unfortunately not, but we do allow proration for stage and office rentals, insurance premiums, and completion bond payments. And on the back end, costs qualify up to 30 days after completion of the final element, such as a DCP or a final answer print.
Can a production start shooting outside of California prior to receiving a credit allocation letter?
Yes, they just can't start shooting in California before they receive their credit allocation letter.
So moving on to the topic of uplifts, has the ability to earn the additional tax credits, what you call uplifts, changed at all?
Yes, it has. Both non-indies and indies can qualify for uplifts. So let's start with the non-indies. Non-independent projects have several ways to earn an additional 5% in tax credits. The first is for visual effects qualified spend in the state. The second for Los Angeles labor that works out of the zone. And third, expenditures purchased or rented and used outside the Los Angeles zone. Non-indies can also earn a 10% uplift for hiring local labor who live and are working outside of the LA zone. Independent films and relocating TV series can also earn an uplift, 5%, for hiring local labor who live and are working outside the LA zone. The music scoring uplift has been eliminated.
You mentioned local labor a lot here. What types of documentation are going to be required in order to determine who's considered local labor?
Well, they're going to need to show a California driver's license or ID and a utility bill dated within 3 months prior to the employment start date, which indicates an outside of LA zone address, and that will be required to earn the extra tax credits. We are urging all production accountants to gather this information when the crew is hired, so they'll have it for the CPA who performs the audit.
As you know, we always get questions about the budgeting process here. When budgeting, do independents need to have detailed lines in their budget for the outside the zone shoot days in order to qualify for the uplift?
No, the out-of-zone principal photography days will come from the schedules. They'll need to indicate on their schedules when they're shooting outside of the LA zone. The local labor which the production anticipates hiring will need to be tagged in the budget to qualify for the uplift.
Colleen, what are some of the other changes within Program 3.0?
Yes, thanks, Wendy. In Program 2.0, 40% of the total funding was for new and recurring television, 35% for non-independent films, 20% for relocating TV series, and 5% for independent films. In Program 3.0, the relocating TV series percentage has been reduced to 17% and independent films increased to 8%, which means 4.8% for 10 million and under, 3.2% for over 10 million. We've also eliminated MOWs from the TV project category. Films, regardless of distribution, may apply in the non-independent or independent film application windows.
So to be clear, what about independents applying for a feature-length film that'll be distributed on television?
Well, because there are no distribution requirements, motion pictures for television can qualify as features in both the non-independent and independent project categories.
Is there still a $2.5 million cap on the credit for independent films?
There is. Qualified expenditures for independent films are still capped at 10 million, although they can earn up to an additional 500,000 with the new local labor uplift. Additionally, the deadline to begin filming in Program 2.0 was 180 calendar days after issuance of the credit allocation letter. In 3.0, most projects must still begin within 180 days. However, projects with qualified budgets over 100 million now have 240 days to commence principal photography.
How much time will these productions have to carry forward their tax credits?
Tax credits in Program 2.0, credits can be carried forward for 6 years. But in 3.0, the tax credits can be carried forward for 9 years. I recommend reviewing our Utilizing Your Tax Credits document on our website for more details.
This next one's for you, Nancy. I understand there was a change with respect to pickup orders.
That's right. In 2.0, recurring TV series were always required to supply a pickup order to receive their credit allocation letter, but they could apply without one. There were no time restrictions as to when a pickup order had to be submitted. In 3.0, any recurring TV series that has not supplied a pickup order within 140 calendar days of the cal date of the allocation period for which they submitted an application will be removed from the queue. The project may reapply in the next available TV application window.
So what if a recurring TV series doesn't get their pickup order within that 140 days and they have to reapply in the next application window? Do they get some sort of priority since they had already been approved?
Yes, recurring TV series always have priority based upon the fiscal year they were originally accepted into the program, and if further prioritization is needed, their jobs ratio.
So Nancy's still on the subject of changes. Are there also changes in reporting requirements?
I can give you one good example that has to do with the community expenditure report. In the last program, productions that spent more than $100,000 in any county outside of LA were required to submit a local community expenditure report. In Program 3.0, the report has to be submitted for every county outside of LA County where filming occurred, regardless of the amount. Productions will need to track local vendor expenditures that were bought or rented and used outside the LA zone, and the salaries of local labor. Accountants are required to tag the counties where the expenditures are incurred, and we have a very helpful list of tagging abbreviations of every county in California on our website.
The jobs ratio is also always a hot topic. What about the penalty for overstating the jobs ratio? Has there been any change to the penalty?
Yes, there has. In Program 2.0, a penalty applied for non-independents beginning at a 10% overstatement and at a 30% overstatement for independent films. Well, in 3.0, the penalty is the same for both types of productions. So if the job ratio has been reduced by more than 10%, the credit will be reduced by an equal percentage. If the job ratio has been reduced by more than 20%, then the applicant or any member of its reporting group or company may not apply to the program for a year from the date of that determination.
Have you ever had a project hit that maximum penalty?
Fortunately not, and we hope it will stay that way.
Colleen, can you tell us about the Career Readiness Program?
Yes, thank you. In Program 3.0, the Career Readiness Program will continue to expose individuals to careers in the motion picture industry. Our participants may come from California community colleges, high schools, or CFC-approved career-based learning programs. But there are a few changes. In Program 2.0, the minimum number of internship hours was 225, and only wages over that number were qualified expenditures. In Program 3.0, the minimum internship hours is now 300 in aggregate, with a minimum of 100 hours per individual, and all internship wages are now qualified expenditures. The minimum number of hours required for a classroom workshop or panel has been eliminated. But beyond that, everything else remains the same.
So moving on to the What's New section. What are some of the completely new elements of Program 3.0?
Program 3.0 has an unlawful harassment provision. This means approved applicants must provide their written policy against unlawful harassment, which include procedures for reporting and investigating harassment claims. Applicants shall indicate how the policy will be distributed to employees and include education training resources.
I understand there are new requirements concerning diversity also. Can you tell us about those?
Each applicant is asked to submit its voluntary initiatives and programs to increase the representation of women and minorities. The diversity initiative statement must include a description of what the program is designed to accomplish and information about how the programs are publicized to interested parties. This requirement is waived for smaller indies. The requirement to submit diversity statistics applies to all productions, and productions will now need to bifurcate statistics between qualified wages versus non-qualified wages.
Nancy, does the Film Commission have any specific programs that encourage the industry to increase diversity?
Yes, we do. The film industry, stakeholders, and legislators recognize the need to provide a pathway for people from all types of backgrounds to gain access to the film industry. So the Film Commission will be jointly administering a pilot skills training program for individuals from underserved communities to prepare them for jobs in the motion picture industry.
If I may ask, how does that program get funded?
The program is funded by the approved applicants who must make a financial contribution of 0.25% of their credit allocation letter amount within 10 business days of receiving their credit allocation letter. Now, this contribution could be reduced or refunded if the project fails to go forward or if there's reasonable cause for a lower amount.
And what would be reasonable cause for a lower amount?
Well, one example would be a television series that initially applied intending to produce, say, 13 episodes, but ended up shooting 8 episodes. So therefore, they would have a lower costs, lower amount of tax credits, and therefore the fee would be lower as well.
Thank you both. This information has been incredibly helpful in highlighting the differences between the previous program and what's new under 3.0. Is there anything else you would like to add?
Well, Wendy, we appreciate this opportunity to talk about it, and we invite all the applicants to review our resources on our website, particularly the chart of accounts, because there have been some changes in the definition of wage versus non-wage, such as box rentals, which are now considered wage. We have so many resources there, including our guidelines, tutorials, and FAQs. But if you need more information, have more questions, please contact the Tax Credit Program staff. We want you to film your project in California.
Look, we recognize this application process can be complicated, but this is a new and improved program, and our staff at the CFC is here to assist you. We want you to film your TV shows and your films here in the great state of California.
For more information on Program 3.0, contact the incentives team at Entertainment Partners at incentives@ep.com or by phone at 818-955-6050 or visit us on the web at productionincentives.com. For information on all things production related, visit us at theproductioncommunity.com.